If almost every money expert calls whole life insurance a ripoff, why do the wealthiest families in America quietly keep buying it on purpose? Hold that question, because the answer flips everything you've been told. You've probably heard the advice 100 times. Buy term, invest the difference. And honestly, for most people, that's mostly right. So why does the very top of the wealth ladder do the opposite? To get there, let me rank the real reasons the rich own whole life, counting down from the weakest, the one critics are actually right about, all the way up to the single reason that matters most. But first, the quick ground rules, because two things get confused constantly. Term insurance covers you for a set window, say 20 or 30 years. Die during it, your family gets paid. Outlive it, the coverage just ends and you get nothing back. Whole life is different. It never expires as long as you keep paying, and it builds a pot of money inside called cash value that slowly grows over time. Think insurance with a savings account bolted on. Now, the countdown. Coming in at the bottom, the worst reason to buy whole life is the one salespeople love most as an investment to grow your wealth, and the critics are flat right to attack this. Whole life is expensive, often 5 to 15 times the cost of the same term coverage. The fees can be steep, and in the early years your cash value grows painfully slow. If your main goal is growing money, a low-cost index fund will almost always beat the returns inside a whole life policy. For pure growth, the math favors investing the difference, no argument. So if you ever hear it pitched as a market-beating investment, that's the worst possible reason and your signal to walk. Next up the ladder, a real reason, but a conditional one, the tax shelter. Once you max out your 401k and your IRA, you run out of tax-sheltered places to grow money, and the wealthy hit that ceiling fast. A whole life policy becomes a bonus tax advantage bucket. The cash value grows without being taxed each year, and structured right, you can borrow against that cash value tax-free. For someone in a high bracket, dodging the tax drag is a real, measurable win. But notice why this ranks in the middle, not the top. It only matters if you're already maxing the normal retirement accounts first. If you're not, those accounts give you the same tax break far more cheaply. Whole life is the overflow, never the starting point. Climbing higher, into the genuinely powerful tier, is certainty. The stock market is wonderful for growth, but it swings. Whole life cash value doesn't drop when the market crashes, it only climbs. For the rich, that's not the engine of wealth, it's the ballast. You take big risks with your stock portfolio precisely because you've got a rock-solid, guaranteed foundation underneath you. Safety in one place buys courage in another. Some wealthy people even use that cash value as their own private bank, borrowing against the policy to buy real estate or fund a deal, while the full balance keeps growing inside. So the money does two jobs at once. And the number one reason, the one that sits at the very top, the real reason the rich buy whole life, estate planning. When a wealthy person dies, their heirs can owe a massive estate tax bill, and they often have to pay it fast, sometimes within months, in actual cash. Imagine inheriting a family business or a farm worth millions. It's valuable, but you can't easily sell a third of a factory to cover a tax bill. Families have been forced to sell beloved assets just to pay. Whole life solves this beautifully. The death benefit pays out in cash, generally income tax-free to the heirs, landing exactly when it's needed, so the family keeps the business, the property, the legacy, instead of fire selling it. And with a smart setup using a trust, that payout can sit outside the taxable estate entirely. This is why family offices and old money dynasties treat whole life as a quiet estate tool, not a get-rich scheme. That's the top of the ranking, and it's a world away from the bottom. The pattern is real, by the way. The whole life industry is built around permanent coverage, and studies consistently show high net worth households own far more permanent life insurance than the average family. The rich genuinely buy more of it. But there's a giant catch, and it's the reason this whole topic has a bad reputation. Most whole life policies get sold to the wrong people. A salesperson earns a fat commission, so they pitch it to families who should be buying cheap term and investing instead. If you're still building an emergency fund, paying off high-interest debt, or haven't maxed your retirement accounts, whole life is almost certainly not your move yet. Those expensive premiums could starve the cheaper, faster tools that actually build your foundation. So how do you use any of this? Get brutally honest about your stage, because whole life is a tool for after you've built a solid base, not a shortcut around the boring fundamentals. Run the simple checklist this week. Do you have 3 to 6 months of expenses saved? Is your high-interest debt gone? Are you maxing your 401k and IRA at current limits? If not, start there. If you genuinely have an estate tax problem or maxed out accounts with surplus cash, talk to a fee-only advisor, not a commissioned salesperson, because a fee-only fiduciary has no incentive to push a product you don't need. And if whole life does fit, understand exactly what you're buying. Ask about the guaranteed cash value, the fees, and how long until the policy breaks even, and make them show you the numbers in plain English, not a sales pitch. The trap to watch: anyone selling it as a magic investment that beats the market is selling you the bottom of this ranking dressed up as the top. Zoom out, and it's simple. The rich don't buy whole life because it's a great investment. They buy it because they've already won the investing game and now need tools for tax, legacy, and certainty. Different problem, different tool. You don't have to feel dumb for not owning it or left out for skipping it, because most people genuinely shouldn't buy it yet. Knowing why is the real financial sophistication. The wealthy aren't smarter than you, they just have advisors who match the right tool to the right problem at the right time, and you can think exactly the same way starting with your next financial decision. Keep the order straight: emergency fund first, kill the bad debt, max the cheap tax-advantaged accounts, and then, only then, if you've got an estate or surplus problem, consider permanent insurance as a precision instrument. So the next time a guru calls whole life a total scam, you'll know the fuller story. It's a bad fit for most, and a brilliant fit for a few, and the difference is simply where you stand financially. It isn't a scam and it isn't a miracle, it's a specialized tool, and the rich just know exactly when to reach for it. Now, so do you. Quick gut check for the comments, and be honest, because I read these and I'll reply to a few. Which rung of that ladder are you actually standing on right now? Emergency fund, high interest debt, maxing the 401k, or maxing the IRA? And has anyone ever pitched you whole life before you were ready for it? That's your real next move, named out loud, long before any salesperson gets a word in. If this finally made the whole thing click, hand it to anyone staring down a confusing insurance pitch this week, drop a like so it reaches more people getting oversold, and subscribe so the next money breakdown finds you too.